Hello, today we're talking about the P&L, the profit and loss statement. Now, why are we talking about this? You probably think, well, I kind of get that. You've got to make sure that you're fully participating in those financial strategic decisions. And pretty much every strategic decision is going to have a major financial impact. So you need to understand those numbers. What we see in small and medium-sized businesses is either the board defer these complicated financial decisions to the accountant, and then the board's not really fully participating, or the board get fully involved, but they're not really thinking about it from a financial point of view. They're just using their guts, they're using their experience, and the chances of making a wrong decision are quite high. So, the P&L. This is your profit and loss statement. Just quickly running through it, at the top you'll have your revenue, that's your sales for the period. Then you'll have your COGS, your cost of goods sold. These are costs directly related to the goods or the services that you've sold. So there will be things like raw materials. When you have your COGS deducted from your revenue, that gives you your gross profit. Now, if you divide your gross profit by your revenue, that gives you your GP percentage. Now, what do you take away from your GP? Well, you take away your cost of doing business. These are your fixed expenses. These are things that don't change with the level of sales that you're undertaking. Things like rent. If you divide your cost of doing business by your revenue, that gives you your cost of doing business percentage. Important to track that so that you're not allowing that to grow faster than you're growing your revenue. Then, when you take away your cost of doing business, your fixed expenses from your GP, that gives you your EBITDA. That's your earnings before interest, tax, depreciation and amortization. Depreciation and amortization is how you expense fixed assets through the P&L. So a fixed asset is an asset you're going to be using in your business for more than a year. You don't take the full cost through at the moment you purchase the asset. You take it through the life of the asset. So to give you an example, if you have a car, it costs you $20,000, you're going to be using it in the business for 4 years, then in year 1 you take $5,000 through the P&L, that's your depreciation for year 1. Then in year 2, another $5,000, another $5,000, another $5,000. That's your depreciation. Amortization is the same, but that's for intangible assets, assets you can't physically touch. Things like goodwill. So once you take away your depreciation and your amortization from your EBITDA, that gives you your EBIT. If you divide your EBIT by your revenue, that gives you your profitability percentage. And then take away interest and your tax, and that gives you your net income number. From your net income number, you then take away any dividends, any drawings, and then that leaves your retained earnings. Your retained earnings are what you add to your equity number, so you're growing your stake in the business, you're growing your share of the ownership of your business by growing your equity. So that's a very rapid fire run through the P&L. Hopefully that's been useful. We'll be looking at other financial statements over the next few weeks. But if you do have any questions or comments, please do get in touch, and we'll be back very soon.